and Don and Emily and Lisk for inviting me. It's really good to be here and to see a lot of familiar faces. And so it's kind of good to reconnect with a few of you. I'm going to share my screen. All right. Just a little bit of background if I don't know you yet. Jerome Garciano, I'm a shareholder at the law firm of Polsinelli. I've been an attorney for almost 15 years now in the tax credit space. I am in Boston. I started my career in Boston after grad school. Very familiar with the area, and again, know a lot of you who are on this call, so it's good to reconnect. Um, I first started off with the recap advisors and the community builders here in Boston, and have since then moved to legal practice, and again do mainly tax credit transactional work, a lot of affordable housing, a lot of light tech. But I think many of you know I've been keeping track of these green incentives, the energy incentives, for a long time now, and so I have kind of a specialty area in that. I assume maybe a lot of you receive my compendium that I distribute to my contact list a couple times a year. Essentially, it's a 50-state survey of the different green-related energy incentives, solar tax credits, energy efficiency, electric vehicle tax credits. So if you're not on that list and want me to add you to that, go ahead and email me. My email is at the bottom of that. But today I am going to go through some of the highlights of the Inflation Reduction Act. I'm going to try to focus on the decarbonization concept that we're focused on today. Just let you know some of the big changes and some new opportunities, particularly that could be applicable to groups that are looking at community development, housing type of work. It's exciting because I've always been interested in kind of combining the community development, working with kind of those on the margins, low-income populations, and kind of the green and the environmental justice piece. And the Inflation Reduction Act definitely, it was passed last year, definitely kind of a big boost to that. And so I think it's exciting for everybody. So just to level set, the Inflation Reduction Act, as I said, it was passed last year. Aside from probably what you would normally think in terms of, clean energy and kind of climate greenhouse reduction, which is, a big part of the policy, there are a few other concepts there in terms of goals of the legislation and the targets for the incentives. So grid modernization is a big one. Looking at infrastructure, energy infrastructure investment, electric vehicle investment for infrastructure as well, but also manufacturing incentives to onshore a lot of these clean technologies, batteries and other types of kind of critical minerals and components for wind and solar. Certainly an angle which I won't focus on today, but if there is kind of economic development goals and maybe your organizations that are connected maybe to job creation, manufacturing, actually kind of this clean job manufacturing angle, I think is a really a good one. And certainly ideas of, reducing greenhouse gas emissions and resilience in terms of, again, kind of a modern day infrastructure for our electric grid. Essentially, the IRA expanded the existing energy tax credits, and so there were quite a number of energy credits before the IRA, but there are a lot of new ones now because of the legislation. And importantly, it introduced bonuses, which I'll cover, to different types of tax credit bonuses, and structural changes that increase participation, hopefully, in these programs. So what I'm going to do is I'm going to go through, I've kind of grouped the incentives, and I'll go through each of them, at a high level, but kind of hopefully enough that you all can be able to identify maybe some opportunities for your organizations or your projects. So the first one is basically energy generation, and so that's primarily electricity, but there are other types of energy, particularly up here in the Northeast, looking at incentives that promote heat in the buildings. And so we have the investment tax credit, which is Section 48. That's the credit that people will normally think about, the solar credits. And there are some new credits that essentially will create a new regime starting in 2025, which I'll go through. And so the first one, again, the investment tax credit, that's typically the one that people will think about, the 30% tax credit for solar. And so that basically got re-upped. Some important changes. If your project is a large project, meaning greater than 1 megawatt, you will need to look at prevailing wage and apprenticeship requirements in order to get to the 30% base amount. So that is a new change in the IRA. And so I'll talk about prevailing wage and apprenticeship in other slides. But essentially, it's a 30% tax credit. Solar, wind are eligible, so those are kind of the big ones. But importantly, ground source heat pumps are now included in that. And so if you're looking at decarbonization, that could be a potential strategy. Certainly lowering the heating load and reliance on natural gas heating systems, I think would be kind of a good opportunity. Batteries, electric battery storage, and other thermal storage is also included now in the investment tax credit. For those of you who might be looking at microgrids, I think that's pretty exciting. Microgrid controllers and interconnection properties that are interfacing with the grid, on a standalone basis now be able to qualify for the investment tax credit generally. And for those of you doing housing tax credit projects, big changes. If your energy project is incorporated into a LIHTC project, the tax credit does not reduce the low-income housing tax credit basis. So I think a lot of us were excited about that. Maybe some of you are already utilizing that. I'll talk about the bonuses later. There's other really good bonuses that will increase the percentage from 30 to 40, 50, up to potentially 70%. But one thing to note is this credit, and generally for solar and wind, is going to be only in place till 2025, at which time a new tax credit will take its place. So this next slide talks about Section 48E. So again, this is starting in 2025. And this one will be in place until the later of 2032, and the year in which the greenhouse gas emission rate is 25% of the 22 emissions. So generally, this is the credit, technically the credit that will be in place, for the long run. And it is a different approach where it's actually technically technology neutral. And so instead of specifying certain technologies like solar, wind, et cetera, any electricity that's generated in a clean way, so essentially no greenhouse gas emissions, will qualify for the 30%. So, I think for the most part, the existing technologies are going to be treated the same way, but there might be other new technologies that get developed that would qualify because since this is a technology neutral. The other major energy credit, which generally won't apply for this group, I would imagine, is the production tax credit. And so that one, usually see in kind of larger utility scales, but there's similar expansions to that. There are some interesting technologies that could elect to become eligible for the investment tax credit in the production tax credits. So particularly some biomass projects, if if there's any interest in that, let me know. Moving on to the next category is energy efficiency. And so certainly part of the decarbonization strategy is to reduce the energy load. So I think there are a lot of interest in some of the high performance the incentives that would support high performing buildings and high energy equipment. The first one here is a existing credit that got expanded and increased. So Section 45L, probably many of you are familiar with, essentially new energy efficient homes, a lot of multifamily projects, especially low-income housing tax credits if they're looking to do very green, high energy efficient buildings, qualify for this and take advantage of this. So essentially you're looking at two categories. The higher category is the net zero ready standard, and then the lower standard is the Energy Star Homes standard. So you see the amounts there on a per unit basis. Importantly, for the multifamily category, if you're net zero, it's $1,000 per unit, but if you are meeting prevailing wage requirements, that actually goes up to $5,000 per unit. So that's certainly, if you could make that prevailing wage work, that is a big increase to what it was before. So you're now looking at $5,000 a unit potentially for multifamily for being net zero ready. And just like the ITC, if it's paired with a housing tax credit project, it doesn't reduce the basis for the housing project. Another existing incentive that got expanded is the 179D tax deduction. Maybe many of you are familiar with that. So generally, this would apply to larger commercial properties. Technically, it's any buildings that really fall under the ASHRAE 90.1 standard. So you're looking at like 4-story buildings, other types of commercial retail property. But essentially, that ASHRAE standard is kind of what you want to be looking for in terms of building type and whether you're under this regime. They changed the amount of the deduction to be a one that's based on how much energy reduction is designed into the building, and so it's now up to $5 a square foot. Again, there is a requirement to get to that higher level for prevailing wage and apprenticeship again. They also introduced a different pathway for existing buildings, and so if the building is 5 years old, at least 5 years old, there are other alternative ways in which improvements for energy efficiency can be met and being able to qualify for this tax deduction. But generally, yeah, it's a sliding scale depending on the energy costs, and so typically, and I think this still applies, although it's not calculated this way anymore. But I think a lot of designers would look at kind of building envelope, HVAC, and lighting to look at some of the performance measures that'll be tested for this incentive. Another big change on the 179D is that private nonprofits can now allocate the deduction to the designer. So that's a change. Prior version, only government owners and public projects, because they didn't pay taxes, they actually could allocate the deduction to the designer of the energy efficient equipment. That now is expanded where private nonprofits can do that as well. All right, the next category is electric vehicles, and so kind of adjacent to the building technologies that we're talking to, but certainly part of the decarbonization movement. You have 3 incentives. The first one I'll go through is the charging station, essentially for electric vehicle charging stations, which is Section 30C. Essentially, it's a 30% tax credit. for non-commercial or commercial that meet prevailing wage. Again, you see this prevailing wage requirement and apprenticeship requirements, which ties into my earlier comments about kind of economic development, kind of job training opportunities. But up to 100 grand for commercial. One thing that was changed in the IRA was if your electric vehicle charging station is located in an urban area, you have to check if that urban area is actually within a new markets tax credit eligible census tract, which is kind of unusual. But I assume a lot of people know, maybe work with new markets tax credit projects, but certain low income areas are designated as those census tracts. So if you're in a suburban or in rural area, you don't need to check that. But if you are in an urban area, that's another analysis you'd need to do. Section 30D is essentially the tax credit for electric vehicles themselves. So this is generally aimed at consumers. So if you were, wanting to buy an electric vehicle for yourself, there were some new restrictions around, where these, how these components of the cars could qualify and which vehicles actually qualify. And also importantly, they introduced income limits to households and purchasers for these electric vehicles. One interesting new credit is the Section 45W, which is for commercial clean vehicles. So think about like buses and fleets and other commercial vehicles, trucks. There's a new 30% tax credit for the incremental cost of the commercial vehicle. And again, think about electric vehicles, but also fuel cell vehicles. And it's up to a certain amount there that are listed there, but could be interesting in terms of some maybe larger projects. Thinking even educational institutions, universities might be, looking to decarbonize their campus, looking at larger incentives for fleets. I won't go in it too deeply, but there are kind of some re-upping of the personal residences. Basically, HVAC, doors, windows for taxpayer residences. You can have a 30% credits with certain limits. So that's back. Section 25D is, again, for homes and residentials for taxpayer residences. 30% credits. So this is your solar panels on the homes. It also includes now battery storage with the changes in the IRA. So if you're looking for something for your home, those are the credits that you'd be looking at. As I mentioned earlier, there are a bunch of new manufacturing incentives. So these are the two. Again, I won't go through it in detail today, but 48C is for a 30% credit. Essentially, it's a competitive credit, but 30% credit for setting up manufacturing facilities for certain clean technologies, advanced energy components. And then 45X is another incentive for manufacturing mainly solar and wind components and battery components. Similarly, there's a lot of investment in clean fuels. And so transportation, aviation fuel that are made from bio, diesel, and clean hydrogen is going to be a big, there's going to be a lot of investment in clean hydrogen as well. So those are two incentives that are dealing with fuels. All right, so I want to move now on to the bonuses. And so there are 4 categories here. So you heard me talk about prevailing wage and apprenticeship requirements a lot here. And so it does run throughout a lot of the incentives in the IRA. Note that that's actually 2 separate requirements. There's prevailing wage, and then there's the apprenticeship requirement. Most of the credits for the bonuses, they're going to want you to meet both, but there are some that are just prevailing wage, actually. But essentially, you look at like a 5X multiplier for a lot of these incentives if you are meeting the prevailing wage. Again, for the ITC, just to be able to get to the baseline 30% that people are normally familiar with, you got to do prevailing wage and apprenticeship. So that's something you need to look at if you do big energy projects. But essentially, prevailing wage, I think most of you are familiar with in the housing and real estate context. Essentially, laborers and mechanics that are employed for building the project needs to be paid by the Department of Labor Standards. So that typically equates to union wages. There are again required trade breakdowns and categories that you need to comply with, and certainly there's a lot of record keeping and kind of audit proofing your project through making sure you're following all the procedures and making all the right payments and such. And so that's kind of a big deal. This is actually one of the biggest changes in the IRA, in my opinion, is this prevailing wage. And I know some people are certainly being challenged by this, and I know there's talk in Washington about kind of trying to work with this, but the second requirement is apprenticeship. And so starting in 2024, 15% of the labor hours need to be performed by federally registered apprentices. So there are these apprenticeship programs around the country. I guess I would question whether how many of them might have apprentices that are going to be qualified to do this particular work, but I assume that the policy is that there's now incentives to start these, and so actually I've been talking with a lot of groups around the country, again going back to the economic development opportunities, looking at job training, especially for marginalized populations, those that have been historically excluded from some of these clean technology jobs, and so looking at opportunities to actually start federally registered apprenticeship programs to be able to meet this need, right? There is a good faith effort exception. If you do a written request to an apprenticeship program and they basically write back saying that they don't have any, you have a bit of a reprieve until you have to actually ask again. And so there are some time limits with that, but it's pretty extensive otherwise. Every contractor, subcontractor is going to need to employ at least one apprentice. Again, if they're employing at least a minimum of 4 people, at least one of them have to be an apprentice. So it's going to be pretty wide ranging of an impact in terms of the apprentices as well. The next bonus is domestic content. I mentioned that one of the policies was trying to onshore a lot of the manufacturing of these components of these energy projects. Essentially, it's a 10% increase for projects that qualify. So if your project would normally qualify for a 30% tax credit, you would go up to 40% of the cost for your calculated credit if you could certify that your components are domestic content. So what that generally means is that all of the steel or iron of your project that are essentially structural components need to be produced in the United States. Manufactured components, they do have a little bit of a wiggle room where at this point 40% of those pieces or components of that manufactured products need to be produced by in the United States, but that percentage is going to be increasing here in a few years. So, but right now 40%, and so again, people are trying to figure out fairly detailed calculations of how exactly you certify to that, especially if the components are made up of subcomponents that have different origin outside the U.S. The next bonus here is energy communities, and so this is another 10% increase, and so and these bonuses are cumulative, so generally cumulative. So if you qualify for the domestic content and the energy communities, you can get another 20% as a bonus. But here are the 3 areas in which your projects can be located in to qualify for energy communities. A brownfield site, so there are some general definitions around phase one environmental studies and such. But essentially, if your project is on a brownfield site, you can get a 10% increase. There are certain metropolitan statistical areas that have high unemployment and have a fossil fuel based economy. And so there are maps put out there. I think if you just Google energy communities, there's like a address lookup. You could look up at least for the bottom two categories. So you can check out if your MSA is one of those. And then the third category is a census tract with a closed coal mine or a coal electricity plant. So again, a former, kind of carbon intensive electricity area that is, I guess the theory of policy being they're trying to transition those areas and those jobs to clean technologies. And so having a bonus for projects located in those census tracts, also adjacent census tracts to those coal census tracts. All right, the last bonus, I call it the environmental justice, and this only applies to solar or wind, and it only applies to the investment tax credit generally. And this is the bonus that is a competitive application. So the application just closed a couple of weeks ago. And so there was essentially a 30-day window so the 30-day window closed a couple of weeks ago. I think I haven't checked recently, but there is a limit in terms of the amount of awards that will be given. And so you see here some of the megawatt sizes, again, based on what category you're applying to. There are certain limit amounts, but I think everybody's going to be waiting and seeing whether those limits were oversubscribed in this first 30 days. I think technically you could still apply, and so I actually hope that there are still some allocation left, and we'll be able to see that. But theoretically, if there was oversubscription, there's going to be a lottery held, or there has been a lottery held to pick the winners. But essentially, if you have a solar or wind project that qualify for one of the four categories, this should be something you look at. And this competition, I think most people think it's happened every year, and so we don't know what the date is for next year's application yet, but it's pretty short notice for this year's process. But essentially, you can get a 10% bonus if you are located in a low-income community, and so again, that's a new market census tract. So you don't. This is just based on location, so you could theoretically get a 10% bonus in a new market census tract or on tribal Indian land. And then you can get a 20% bonus if you are part of a low-income residential building, essentially affordable housing, and that you allocate benefits from that energy project to the residents. So that's a big requirement, and we were working through that with a lot of groups that I was working with. And then the fourth category is called the low-income economic benefit project. So that one, it does not have to be located on affordable housing. So if you think about kind of a standalone community solar project, but the financial benefits, 50% of the financial benefits of that project need to be provided to low-income households. So things like selling electricity at a lower cost to certain AMI households, certain poverty line households would qualify for that. Other things to talk about. So this is you have to be under 5 megawatts. So that was actually a big, some of the projects I was talking with, they were at 5 megawatts, and you actually technically have to be under 5 megawatts. So that is something you should look at. Generally for projects that are built on buildings, that's not going to be a concern because that's a pretty big project. But if you're looking at community solar, that would be something to look at. So So yeah, hopefully there's still allocation left, but I'm not sure about that. All right. This is the last section. This will be talking about some new elections and some structural changes. There are also some really big changes for the energy credits. The first one is for tax-exempt organizations. I call this kind of the direct pay cash refund option for tax credits. But essentially, there is a new election where nonprofits, also kind of governmental agencies, other entities that don't pay tax, can now elect just to take a cash refund if they qualify for a credit. So the theory being because tax exempt entities don't pay federal income tax, they don't have a use for the tax credits. Now, if they own the project and they're able to qualify for a tax credit, they can just make an election and get a cash refund for the value of that credit. So if you have 30% credit that's calculated to be $1 million, you can now make an election and get $1 million from the IRS as a cash refund. So that's a really big change, a really good change, I think. They're starting in 2024. If you don't start construction in 2024, it actually is 90% of the amount, so there is a little bit of a haircut. In a couple of years here, there are some exceptions for small projects and domestic content projects, but for generally, that's a pretty good deal. You get 100% of your tax credit. Prior to this, if you were a tax exempt organization, you'd have to enter into a partnership structure with an investor. Probably a lot of you are familiar with the 99% tax credit structures with housing and such. So similarly, tax exempt organization would have to have done that, and done some other complications to structure that. But now, once this platform is up, which I don't think is up yet. I've heard rumblings that hopefully will be up very soon. But once this is up, a nonprofit, university, hospital, public school, nonprofit housing organization, housing authority could get a cash refund. And so I think that's a really good thing. It simplifies things, especially for smaller projects, that we're generally talking about solar projects on like housing or on real estate. Doing some of those complicated structures just really isn't worth it. So I think this simplifies it a lot. So that's a really big change. The sister election is for taxable organizations. So if you are not a tax-exempt organization, there is now a new election. So they call this the transferability provision, where the owner can basically transfer the tax credit now to an unrelated taxpayer for cash. So again, prior to this, if the owner could not take the tax credit themselves, they'd have to create a partnership with an investor, with a big, a bank or insurance company that had a lot of tax liability. But now there can be just a simple election to move that over and basically sell the credit, making it really similar, although not completely similar, to a lot of the state tax credits that maybe some of you are familiar with, like a certificated tax credit transaction. Not quite like that, but it's definitely closer to that than the complicated partnership tax structures. Just note that only the credit is transferred. Depreciation is not transferred. And that is one of the benefits of the partnership structures, where the depreciation also can be shared with the investor, but not in this case. So again, we're all waiting for the final guidance and the platform. There's a registration that the project need to get a number, and we need to figure out what forms exactly are filed. But there are groups that are already planning for those types of transactions, the cash refund for the nonprofits, and then the transfer for the for-profits. Last slide here is a reduction, just a note for if a project has tax-exempt bond financing, there's a little bit of a haircut in terms of some of the credits. So the investment tax credits the new energy tax credits. If you actually finance some of that project costs with tax-exempt financing, there is a little bit of a haircut. So they're trying to prevent a little bit of double dipping on this. I've seen it where some projects that have tax-exempt bond financing, like for 4% deals, also have solar, as part of that project. So I think there have been some attempts around kind of accounting for that separately, where the tax-exempt bond financing is not being used to pay for the solar to avoid that haircut. But we'll see if that generally works. But I have seen that used. So if you do have a 4% deal, you should just double check that you are providing for this, that tax-exempt bond financing haircut. So that is the end of the presentation. So again, if you have any questions, I guess, Sylvania, do you want?
Yeah, we have
anything we don't get to, because I think there might be a lot of questions, but if anything we don't get to, certainly you can reach out to me. My email address is on the screen, but yeah, no, I'll hand it back to you, Sylvana, about the Q&A session.
Yeah, well, thank you so much, Jerome.
One thing, I'm sorry, this is Don. Jerome, I think it's best for you to stop sharing now, just so people can see each other on the screen.
Sure.
Thank you so much. So Sylvana, sorry, go ahead.
Yeah, no worries. So yeah, I'll just get right to it, because we got a healthy amount of questions that built up. So the very first one was from Echo at the Community Builders. It's kind of a multi-part question, so you might want to just read that one too, but it's on 179D. The first one is, does this apply to large multifamily residential and mixed-use buildings? And if so, if the building is owned by the for-profit LLC, could that LLC take the deduction? So we can start.
Yeah, so yeah, I think generally, yes. You need to double check whether it's under that ASHRAE standard that I mentioned. And I think it was, I can't remember if it was 3 or 4 stories. So if you have a larger building, mixed use, definitely you're seeing that. But it really, I think technically is whether the design of your building fall under that ASHRAE 90.1 standard. But I think generally, yes. And then the owner, as the owner, would have that deduction. And so that would be a bonus. So one thing to note is that it's not a credit. That 179D is not a tax credit. It's a tax deduction. So generally, it's kind of less of a value than you normally see in a credit, but that would go to the owner. But as I noted, if you're a nonprofit or a government agency, you can allocate that to the designer, which is, I've actually worked with a lot of designers who are interested in making sure that they get that, because that's a financial benefit for them. But that's definitely a planning opportunity to add hopefully some value to the project.
Actually, that's a perfect segue, because the next question was, what is the definition, the definition of designer in terms of where the deduction typically goes, and does the tax code specify certain types of firms?
Yeah, I think technically the requirement is the designer who specified the energy property, like the energy efficient property. So, I mean, typically that's going to be the architect, but I could see it being the engineer. I think I heard, if there's an engineering firm involved or some other specialty vendor, I think that should be able to qualify. So, yeah, I guess one thing I know is I definitely, if the project isn't built yet and you're in the early stages, like actually trying to figure that out and actually having a business arrangement of kind of exactly what's going to happen with the deduction is going to be important. And so, yeah, I think generally, if the firm or the individual is the one who's responsible for the specification of the equipment, that's going to be your designer.
Thank you. Instead of reading, Alyssa, do folks want to come on the mic, or are you fine with me just reading it?
I'm fine with you reading it. I actually have a terrible cold.
Oh,
so
God.
Please go ahead.
It got you too. Okay. So Alyssa is asking, for personal residences, can a nonprofit rehabbing a vacant, SF home, to sell as affordable access, any of the, I can't read. Can a nonprofit rehabbing a vacant home to sell as affordable access any of these incentives, or are these only for?
Yeah, That's a tougher one. I think one possibility would be 45L, again, if you happen to do such a substantial rehab that it's actually kind of a new home. So I think it depends on kind of how much of a rehab it is. My guess is most of these projects aren't going to be that deep, but certainly, the property has to be, for most of these incentives, the property has to be like a income producing or some part of your trade or business. So it's either that or having the incentives go to the homeowner when the homeowner buys the project. And so I think there could be some planning opportunities there, but trying to thread the needle where a nonprofit developer is rehabbing the home to sell for a home for, like, let's say, for example, for a first-time homeowner. I think it could be done, but I think you definitely need to look at kind of the sequencing and kind of how that gets documented. But it's not as straightforward as if you were just doing a rental property and, obviously the nonprofit owns the rental property, et cetera.
Thank you. Paul, do you want to come on, or I can just read it also?
You can just go ahead and read it. Simple question, but
so is there a formal definition of a brownfield site?
Yes, I think in some guidance they've can't recall the exact language, but I think it's essentially if there was like there's some level of contamination that's identified in a phase 1. I'd have to look at kind of the formal definition, but there are regs around that definition. And it has to do with some type of, documented environmental reporting. I generally think it's a state issue. I'm not certain about that, but I know there was reference to phase 1s in the regs.
well, yes, that's part of the question. I'm in Massachusetts, and Massachusetts does not, as far as I can determine, have a formal definition for a brownfield site. They have legislation that talks about provisions for brownfield site developments and liability issues and so forth. So I was wondering if the feds had a definition. So
yeah, I'd have to look into that one. I mean, I'm generally thinking that still should be okay for Massachusetts projects if there's a phase 1 that shows some environmental contamination. And so I think in that way, the federal legislation and regs are trying to bring that piece of it in. So, but yeah, I could certainly could reach out if you want to talk offline more about that.
Okay, and Chrissy, I did see you cough, so I wasn't sure if it got you too, but so Chrissy asks, will there be a second round next year for Section 48 credit adders for projects that weren't ready to submit this year?
Yeah, hopefully, if it's still around. But yes, I mean, the legislation is in place, and that's the plan. We don't know what the date is. It's interesting. I'm trying to get a sense of how many people actually applied. I'm hearing there are some groups have applied like for multiple projects, and then I also talked with a lot of people that just weren't ready, and so I'm not exactly sure what the response is. So I'd be curious to see if the allocations were already oversubscribed. So technically, if you do have a project that is ready, you can still apply right now. I just don't know if the lottery happened and if there actually isn't any for this year, but certainly next year, everybody will be more prepared and there'll be more time understanding how this is going to work. But generally my, kind of going through it is fairly straightforward. Just if your project is ready. And the weird thing is, like, there's a 4-year window in which you when you apply and you get awarded for this bonus, you have to place your solar project in service within 4 years. So that's pretty far in terms of the back end. But there's also some requirements around kind of readiness and there's certain level of progress you have made on your design of your project to actually apply. So there's like an interesting window in which you need to apply. And so I think the timing of this really is important, and kind of how your project gets designed and where in the project phasing and stage like it is. So keep an eye out for those deadlines. I'm hoping it's going to be earlier in the year than it was for this year, but who knows?
Thank you.
And seemingly last but not least, William asks, is there an increase in federal solar geothermal tax credits from 30 to 40% for certain nonprofit applicants?
So the geothermal, so just to clarify, there's actually a couple descriptions around geothermal. So there's one is geothermal is creating electricity, and so that there is still tax credit for that. There is a new tax credit for ground source heat pumps, which is very interesting. So those generally have bonuses for that apply to other projects like solar, with the exception of that environmental justice bonus. So the environmental justice bonus that we just talked about that has a competitive application, that only applies to solar and wind. So it does not apply to ground source heat pump, does not apply to CHP, but the domestic content one, the energy communities one, those have opportunities for bonuses, but that's not tied to ownership in terms of having a nonprofit or a for-profit own it. That's based on the location, and it's based on whether the components of the equipment are made in the United States or not. So those are the only 10% bonuses that would apply to either geothermal electricity or ground source heat pumps.
Thanks, Jerome. So this is about all the time we have left just for the session, but of course, as Jerome said, we'll share his contact information if y'all have others that pop up after we're done. And I'll pass it over to Dawn for announcements.
Thanks, Savannah, and thank you very much, Jerome, for providing all that information and answering questions. So the first announcement we have, I'm going to turn it over to Anna Vanderspeck from the Green Energy Consumers Alliance, and we'll go from there. Anna.
Hi, everybody. I am both on my laptop and phone because I think my internet will die any moment, but hopefully it'll stay long enough for me to say hello. So my name is Anna Vanderspeck, and I work with a nonprofit called Green Energy Consumers Alliance. We work across Massachusetts and Rhode Island on clean energy issues, and Dawn very kindly invited me to speak for a couple minutes because there's an opportunity right now that I wanted to make sure you guys are all aware of. So Massachusetts has had a rebate for the purchase of electric vehicles for a long time, but this summer it underwent some changes that not a lot of people know about. So for the first time, the rebate is now available for used electric cars. There's an adder, so if you are a low-income driver, the rebate amount is higher. And it's also now available at the point of sale at participating dealers. So instead of having to purchase a car, then fill out an application, then wait a couple weeks to get a check in the mail, you can get that cost reduction right at the point of purchase for used vehicles too. And so the nonprofit I work for is working with the organization that administers that state rebate program to try and get the word out. And we are looking for community-based organizations across the state that might be interested in doing some sort of joint education work, anything from sharing some information on social media to hosting a workshop to hosting a ride and drive event, or really any other ideas. We're open to hearing what you think would be best. And we do have some pass-through funding available to make it possible to do some work together. So I just wanted to let you all know, A, that those changes have happened, and then B, to reach out to me if you're interested in doing any kind of outreach work. I would love to chat.
Thank you, Anna. And if I will, when we send out notes from the meeting, I will send out your email address. And if you have any link that you want me to include in the notes, just send that to me as well, and we can include that. Thank you, Anna, so much. Anyone else have announcements? We have a few more minutes, and if you have an announcement, please just unmute yourself and make it. Thanks. Okay, I think that no one else has announcements. So I'll be working with Silvana. We'll be sending out the slides, couple pieces of information along with contact information for both Jerome and for Anna. We will send out the recording. Silvana, am I missing anything, or do you want to sort of wrap things up? That would be great. But thank you to everyone. So Silvana, it's all yours.
Yeah, no, I hope we covered it all. Whatever we didn't, we'll just send that over via email with the other resources. But yeah, thank you everybody for your time. And yeah, I guess this is the last session for the year, right? So wow, Happy New Year, everybody. Thank you so much again, and we'll see you in 2024. Again, if you're not signed up to receive updates for new sessions, we'll send that link out as well. But yeah, thank you for being here with us today, and happy almost weekend. Have a great day.